There's a pattern that has repeated 4 times in the last century of American economic history. Each time it repeats, interest rates fall significantly from a high. Not gradually, not slowly, but in a meaningful, sustained, multi-year decline. And every single time that has happened, an unusually large number of completely ordinary people quietly build serious wealth while the rest of the country watches from the sidelines. This isn't speculation, it's documented. You can track it in Federal Reserve records, in household net worth data, in real estate transaction histories, in bond market returns. The mechanics change slightly each time. The assets involved shift, the industries that benefit shift, but the underlying pattern is the same. Rates fall, capital moves, and specific categories of ordinary investors who understood what was happening are permanently changed by it. Here's where I need to be direct with you before we go any further. There is no guaranteed path here. Real risk is involved in everything we're about to discuss, and anyone who tells you a falling rate environment automatically makes you wealthy is lying to you. What I can tell you, and what the historical record actually supports, is that there is a documented pattern. It has produced measurable outcomes for non-insiders 4 times in the last 100 years. And the conditions that define it are present again right now in 2026. Today, I'm walking you through exactly what that pattern looks like, what the data says about prior cycles, the 3 layers where ordinary people built wealth when rates fell before, and the specific decisions available to you today. Subscribe if this kind of research is useful. There's more where this came from. Let me start with the problem. Because the problem isn't that ordinary people didn't have access to these moments. The problem is almost nobody recognizes them while they're happening. Every single time a major rate cycle has turned, every time the conditions that historically produce new wealth classes have been present, the majority of people have found out it was a big deal only after it had completely played out. They read about it afterward, they watched the documentary, and they said the same sentence every time. I should have done something. Let me show you what that looks like in practice when I'm with actual numbers. In 1982, the Federal Reserve began cutting interest rates from a historic high of 20%. They had been raised that high deliberately by Fed Chairman Paul Volcker to break the back of the inflation that had been strangling the economy through the late 1970s. By most accounts, it worked. Inflation fell. And then, as inflation came down, the Fed started cutting. Over the next several years, rates declined from 20% toward the high single digits. What most people saw was the end of a painful era. Lower mortgage payments, a recovering economy. What they didn't see clearly enough, not in real time, was what was happening to asset prices across the board as that capital, which had been sitting in high-yield safe instruments, started moving. Stocks went on one of the longest sustained bull runs in American market history. The Dow Jones Industrial Average went from around 800 in 1982 to over 11,000 by 2000, a run of nearly 1,300% over roughly 18 years. Bonds, counterintuitively to most people, performed exceptionally well during the initial falling rate period because bond prices move inversely to yields. When rates fall, existing bonds paying the old higher rate become more valuable. Real estate, cheaper to finance at lower mortgage rates, began a sustained appreciation cycle. According to Federal Reserve data, American household net worth roughly tripled between 1983 and 1999. Most ordinary people did not capture most of that. They were cautious after the painful years of the late 1970s. They waited until the trend was obvious. Some of them finally entered. Stocks, real estate, bonds. Right around the late 1990s, when prices had already reflected most of the cycle's gains and sentiment was at peak confidence. They got in late, the cycle ended, and they walked away with the lesson that the market was unpredictable and dangerous. The people who understood what was happening in 1982, who recognized that a sustained rate decline was beginning and that capital was going to move in predictable directions, did not need to be hedge fund managers. They needed to understand one thing. When the price of borrowing money falls significantly over a sustained period, specific categories of assets respond in documented ways. That's not a secret. It's not insider knowledge. It's economic mechanics that are part of the public record. But in 1982, most people were too focused on the relief of the painful moment ending to position themselves for what the next chapter would produce. And now, here we are. The current macro shift. The Federal Reserve raised interest rates at the fastest pace in 4 decades between 2022 and 2023, from near zero to over 5% in roughly 18 months. The stated goal was the same one Volcker had in 1979: break the inflation that had taken hold after the post-pandemic money supply expansion. And just as it did in the early 1980s, the aggressive tightening worked. Inflation, which had peaked above 9% in mid-2022, fell steadily. And as it fell, the Fed began cutting. Rates are now falling. The direction is established. The debate among economists isn't whether rates are declining. It's how far and how fast. I want to be honest with you about something before we go further into the implications. This could move more slowly than historical analogs suggest. The economy in 2026 is different from the economy in 1982 in ways that matter. Higher levels of government debt, a different global trade environment, structural changes in the labor market that didn't exist 40 years ago. There are legitimate reasons a rate decline cycle in this environment might produce different or slower outcomes than prior cycles did. I'm not dismissing those differences, but I want to show you what has historically happened across multiple rate decline cycles, not just one, because the pattern predates any single economic era. Here's the 3-driver structure that defines what's happening right now. Driver 1, the rate decline itself. This is the most direct and the most discussed. When borrowing costs fall, the math changes on virtually every major asset class. Real estate becomes cheaper to finance, which supports price appreciation. Bonds become more valuable as existing higher yield instruments get bid up. Equities, particularly dividend-paying stocks and rate-sensitive sectors like utilities and REITs, reprice upward as the discount rate used to value future cash flows declines. These are not opinions. They're the mechanical relationship between interest rates and asset prices that you can verify in any financial economics textbook. Driver 2, the credit expansion. This is the part most people miss when they think about falling rates. It's not just that borrowing becomes cheaper for individuals. It becomes cheaper for businesses. Corporations that had been holding off on expansion because financing costs were prohibitive start to move. Small businesses that had been running lean start to invest. Historically, the 12 to 36 months following the beginning of a sustained rate decline cycle have been characterized by meaningful credit expansion, new business formation, new hiring, new capital investment. That creates its own economic momentum, separate from the direct asset price effects. According to data from the Federal Reserve's flow of funds accounts, the 3 years following the beginning of the 1983 and 1995 rate decline cycles each showed significant acceleration in business credit growth, which preceded broader economic expansion by 6 to 18 months. Driver 3, the capital rotation. During high-rate periods, enormous amounts of capital sit in safe, high-yield instruments, money market funds, Treasury bills, certificates of deposit, because the yield is attractive relative to the risk. When rates fall, that yield disappears, and capital by nature moves toward yield. In the 12 months following the beginning of the 1995 rate decline cycle, money market fund balances declined by over $200 billion as investors rotated capital into equities and real estate. That rotation itself, the movement of capital from one category to another, is what drives the price appreciation in the destination assets. It isn't speculation, it's documented capital flow. And today, according to the Investment Company Institute, money market fund balances heading into this rate cycle are at the highest levels in recorded history, roughly $6 trillion in the United States alone. That capital is sitting in instruments whose yield is now declining. It has to go somewhere. 3 forces, all pointed in the same direction, all documented in prior cycles, all measurably present in the current environment. That's what the pattern looks like from the outside. Now let me show you where, inside that pattern, ordinary people actually built wealth, because it wasn't everywhere and it wasn't random. The 3 layers. In every prior rate decline cycle, wealth wasn't created uniformly. It was created in layers, 3 specific layers, each representing a different kind of opportunity, a different entry point, and a different level of engagement. And in every cycle, each layer was visible in advance to anyone who looked. The challenge wasn't access, it was recognition. Layer 1, the fixed income layer. In every rate decline cycle in the last century, the first layer, and the one almost nobody outside of professional finance talked about early, was fixed income, specifically long-duration bonds. This is the layer that feels the most counterintuitive, because most ordinary people think of bonds as boring, conservative, low-return instruments. They're not wrong about that description during a stable or rising rate environment, but during a falling rate cycle, long duration bonds do something that surprises people who haven't seen it before. They appreciate significantly in price. Here's the mechanism, simply stated. A bond is a promise to pay a fixed interest rate for a fixed period. If you hold a 30-year Treasury bond paying 5% and rates in the broader market then fall to 3%, your bond, which still pays 5%, is now worth more than its face value to any buyer who wants income. The longer the duration, the more sensitive the bond's price is to rate changes. This is called duration risk, and it works in your favor when rates are falling. In the 1982 to 1986 period, the first 4 years of the Volcker-era rate decline, long-duration Treasury bonds produced total returns of roughly 40 to 60%, depending on the specific instrument. That outperformed equities over the same short window. Most ordinary investors in 1982 were not in long-duration bonds. They were in savings accounts and CDs, chasing the same high rates that were about to disappear. The people who understood that the rate environment was changing and that their high-yield CD was about to renew at a fraction of its current rate moved into long-duration bonds instead, locking in that yield and capturing the price appreciation, the recognition barrier at the time. Bonds were associated with conservative near-retirement investing. Most people in their 30s and 40s in 1982 simply weren't paying attention to fixed income because it wasn't for them. What it looks like today, long-duration Treasury bonds, long-duration bond, ETFs, instruments like TLT or similar funds that hold 20 to 30-year government bonds, are in the direct path of the price appreciation that historically follows a falling rate cycle. The specific risk here is timing and pace. If the rate decline is slower than expected or reverses, these instruments fall sharply. That's real. But as an entry point to a rate decline cycle, the fixed income layer is the most accessible, the most directly mechanical, and the one that requires no thesis about which company or sector wins. Just a view on the direction of rates, which the Fed itself has communicated publicly. Layer 2, the credit layer. The second layer is where more ordinary people participated in prior cycles, and where the returns were often larger but required a longer time horizon and a different kind of patience. The credit layer is real estate. In every falling rate cycle in the last century, the real estate market has responded to lower mortgage rates with some combination of increased transaction volume, price appreciation, and improved affordability, though not always in that order and not always uniformly across geographies. What's consistent is that the cost of financing a real estate purchase falls when rates fall, and that affects both individual buyer behavior and institutional capital flows. In the mid-1990s, as rates declined following the Fed's tightening at the start of the decade, real estate began a sustained appreciation cycle that continued, with some interruption, until 2007. Ordinary people who bought homes or investment properties in 1993, 1994, and 1995, when the memories of real estate stress from the early 1990s were still fresh and most people were hesitant, captured a decade of appreciation. According to the Case-Shiller Home Price Index, national home prices roughly doubled between 1993 and 2005. That's a return compounded across 12 years using leverage, a mortgage that most ordinary people had access to but weren't thinking about as an investment mechanism because they were still cautious from the downturn that had just ended. The recognition barrier at the time, the early 1990s real estate downturn, was recent and painful. People remembered it. Buying real estate in 1993 or 1994 felt like touching something that had just burned them. The majority waited until prices were already well up, until it felt safe again, and they got in late. What it looks like today, real estate in 2026 is complicated by affordability constraints that weren't present in 1993. But the credit layer isn't limited to residential real estate. REITs, real estate investment trusts, allow ordinary investors to access the real estate credit cycle through a brokerage account, with no down payment, no property management, and lower capital requirements. Mortgage rates falling also affects commercial real estate, which had a significant correction in the 2022 to 2024 period, as higher rates made financing untenable. The recovery from that correction in a falling rate environment is a documented historical pattern. This layer requires a longer time horizon than the fixed income layer. Real estate cycles play out over years, not months. And the honest caveat is that affordability and inventory dynamics in the current housing market make the residential path more complicated than it was in 1993. Layer 3, the equity re-rating layer. The The third layer is the one that has historically produced the largest returns for ordinary investors who participated, and the one that requires the most patience, the most conviction, and the most understanding of why it happens. When rates fall, the discount rate used to value future corporate earnings falls with them. This means that companies whose value is weighted toward future earnings, growth companies, dividend growers, highly leveraged businesses with strong cash flow, experience what economists call a multiple expansion. The same earnings discounted at a lower rate produce a higher present value. The stock price goes up not because the company got better, but because the math of valuing it changed. In the 1983 to 1999 period, this dynamic played out across the entire equity market, but it was particularly visible in specific sectors. Utilities, which carry significant debt but pay reliable dividends. Financials, which benefit directly from credit expansion. And consumer staples companies whose consistent cash flows become more valuable when the discount rate falls. According to data from Robert Shiller's historical market database, utilities and financials as a sector delivered returns significantly above the broad S&P 500 during the 1983 to 1989 period, the period most directly corresponding to the initial rate decline phase. The recognition barrier at the time. Most ordinary investors in 1983 were not thinking about the mathematical relationship between discount rates and equity valuations. They were thinking about whether the economy felt stable enough to invest. By the time it felt stable enough, the multiple expansion had already begun. What it looks like today, rate-sensitive equity sectors, utilities, REITs held as equities, dividend-paying financial stocks, and certain categories of real estate developers are sitting at valuations that have been compressed by the high-rate environment of the last 2 years. As rates fall, the mechanical repricing of those future cash flows is the same process it's been in every prior cycle. Low-cost index funds that overweight dividend-paying and rate-sensitive equities, value index funds, utility sector funds, are accessible entry points to this layer for investors with a standard brokerage account and a multi-year time horizon. The honest risk here, equity markets in 2026 also carry elevated valuations in certain sectors unrelated to the rate cycle, which means broad market risk is present even for investors specifically positioned for the rate decline dynamic. The specific decisions framework, understanding the pattern, is not the same as knowing what to actually do. And I want to be careful here, because this is the part of this kind of video where vagueness does the most damage. So let me be specific. These are 4 graded decisions, ordered from most accessible to most requiring of conviction, that directly correspond to what the historical record shows ordinary investors did during prior rate decline cycles to capture the pattern's benefits. Decision 1. Reposition the cash you already have sitting in high-yield instruments. This is the one that requires no new capital, no new accounts, and the least amount of conviction to execute. If you currently hold money in a high-yield savings account, a money market fund, or a CD that's renewing soon, that yield is going to decline. The Fed has told you so explicitly. The historical pattern says that capital sitting in those instruments during a rate decline cycle earns progressively less, while other asset classes reprice upward. The decision is simply this. What portion of that capital should be repositioned into instruments that benefit from falling rates rather than instruments whose yield falls with rates? For most people, some portion stays in cash for genuine short-term needs, but the portion that's parked without a specific short-term purpose, the capital with a 3 to 7 year time horizon, is sitting in exactly the wrong place if the rate cycle follows historical precedent. If you do nothing else from this video, do this one. Look at your money market balance and your CD renewal dates. Know when your yield is going to reset lower. Decision 2. Add duration to a portion of your fixed income allocation. This is the fixed income layer in practice. If you hold bonds or bond funds, including in a 401k or IRA, examine the average duration of that holding. Short duration bonds behave almost like cash during a rate decline cycle. Long duration bonds capture the price appreciation. The decision is whether any portion of your bond allocation should be shifted toward longer duration, specifically because the rate environment is changing. This requires a view on the direction of rates, which is not guaranteed, and a tolerance for the volatility that comes with long-duration bonds. Honest risk, if the rate decline is slower, more interrupted, or reverses, long-duration bonds lose value. This is not a risk-free decision. It is a decision informed by historical pattern. Decision 3, identify the rate-sensitive equity categories in your current portfolio and your target portfolio. Most broad index funds have some exposure to rate-sensitive sectors already: utilities, financials, real estate. But a market cap-weighted S&P 500 fund is currently heavily weighted towards sectors that are less directly connected to the rate decline dynamic and more connected to other growth narratives. The decision is whether to tilt a portion of an existing equity allocation toward the sectors historically most responsive to rate declines, without abandoning the low-cost, diversified approach that still makes sense across all environments. Value index funds and sector-specific ETFs for utilities or dividend growers are accessible, low-cost instruments for this tilt. Decision 4, and this is the one most people won't make. In every prior rate decline cycle, the ordinary investors who built the most significant wealth weren't the ones who repositioned their existing savings. They were the ones who used the falling cost of borrowing to acquire assets, usually real estate, occasionally businesses, at a point when the financing made the math work in a way it hadn't during the high rate period. This requires capital, creditworthiness, and the willingness to take on leverage when most of the people around you are still cautious from the recent high rate environment. It's the hardest decision emotionally and the most consequential historically. In 1983, the people who borrowed at what felt like still high rates to acquire real estate or dividend-paying businesses were correct that those rates were falling further. They captured both the appreciation and the falling cost of debt. The risk is obvious. Leverage amplifies losses as well as gains, and if the rate environment doesn't follow the historical pattern, the math reverses. This decision belongs only to people who understand the risk they're taking and have the financial stability to absorb it if they're wrong. Here's how this ends. Not this video, but this cycle. In 2038 or 2040, someone is going to make a video about what happened in the years following the 2024 to 2026 rate decline. They're going to show the household net worth data. They're going to name the sectors that repriced. They're going to talk about the capital that rotated out of money markets and into bonds and real estate and rate-sensitive equities. They're going to document, with the clean clarity of hindsight, exactly what the pattern produced for the people who recognized it in real time. And a large number of people watching that video are going to say the same sentence that people have said after every prior cycle. I should have done something. They'll mean it. They'll remember 2026. They'll remember that rates were falling. They'll remember that they heard about it, read about it, maybe even watched a video about it. And they'll wonder how they were standing directly in front of something that was documented, that was happening in public, that followed a pattern with a 100-year track record, and still came away from it unchanged. The people who don't say that sentence aren't smarter. They're not richer to begin with. They just refuse to be the person who understood the pattern intellectually and still watched from the sidelines. Which of the three layers lands closest to where you are right now? The fixed income layer, the credit layer, or the equity re-rating layer? Drop it in the comments. I read every one. Like this video if the historical framing was useful. It helps other people find it when they're trying to figure out what's happening to their money. And I'll see you in the next one.